Hey everyone, thank you for jumping back to the Crypto Ods. Please subscribe the channel and thumbs up the video. Today we're going to talking about a theory. We'll examine the clues and see if we can reach a conclusion. Are we getting close to another bubble? Are we about to experience a new .com bubble in the market leading to a major crash? The chart you are looking at right now is the S&P 500 with the number of jobs created. Let's go back to the 2019 when a large number of the jobs were lost. You see, the S&P dropped sharply. You see that drop? But as those jobs came back and employment started rising again, the S&P also began to recover and move upward. In 2022, when the Federal Reserve began rising interest rates, the number of available jobs started to decline due to high borrowing costs and businesses struggling to cover expenses. This downtrend has continued even though the Fed has already cut rates several times from approximately 5.5% down to 4% right now at this current situation. Yet the S&P doesn't seem to care. You see the job opening dropping down and S&P goes up. The S&P doesn't seem to care. It keeps pushing higher at full speed. How is it possible that jobs aren't being created, unemployment remains high, but company stocks keep rising? It's not reasonable for me. If you look throughout history, every time, you see, a significant number of jobs were lost, the stock market eventually followed with the decline. People lost their jobs and the stock market crashed. Lost their jobs, the stock market crash. Lost their jobs, market is, you see, goes down. But right now there is a different. Just take a look at the charts of companies that have heavily invested in AI, like Nvidia or Amazon. You see the Amazon, the Microsoft. You see the Microsoft, the Google. These are the same companies that have laid off a large portion of their employees. So how it's possible for their stock to rise this much? You see, when a company lays off a significant number of workers, it usually means one of two things: it's facing budget constraints, or it's cutting costs because profits aren't strong enough. In most cases, that would signal weakness, not strength. Yet instead of dropping, these companies' stock keep climbing. So do you really think this is anything other than a bubble in the market? And this is the chart shows the S&P 500 divided, if you see, divided US M2 supply. by amount of the US liquidity printed. I mean, if you came back, if you look closely and go back 1 year before 2000, here we are here at the 2000, 1 year before 2000. In the 1999, the market had a correction right before its final bullish leg. You see this one before this final bullish leg. This leg, I mean. Then it started to rise again until around March, April. Look at the date. March or April 2000. When the major crash occurred. After that, the market started to crash. The bubble, the dot-com bubble, I mean. Now, in 2025, we saw a drop in January. You see here, this January hits our bottom around May, sorry, and have been rising the last bullish leg, since forming what looks like the final leg upward. So the real question is, are we getting close to the next big crash? Let's see this one. Okay. If we look at the chart of gold divided by US liquidity printing, we can see that we've reached levels similar to 2011 or 2012, like here you see 2012 in terms of value, and we are observing similar rebound reaction on the chart. We are here. What is this candle show you? The pressure of the selling, you see, like here at the gold. But this recent rise in gold prices wasn't driven by retail investors. It was driven by China, which started buying gold aggressively since 2023. Where is my picture to show you? Here you are. You see, China gold stock. In fact, nearly all central bank here, yeah, 7 central bank gold demand remains. All central banks around the world have been buying gold at record levels. So here's the question. Could it be that governments are intentionally creating a FOMO among global retail investors, pushing them toward buying gold only to dump their holdings later, leaving retail investors holding the bag and using the profit to cover the massive debts accumulated in the recent years? It's an open theory. I haven't found any solid article that completely disproves it yet. If you think I'm wrong, I'd honestly love to hear your perspective.